Hi, my name is Elliot Gu. I'm co-founder and chief strategist for Energy and Income Advisor. On January 1st, OPEC's deal to cut oil production by 1.2 million barrels a day officially went into effect. And on January 20th, at noon Eastern Time, Donald J. Trump will officially be sworn in as the nation's 45th president. I believe these two events will bring major changes to global energy markets. Once-in-a-generation shifts for markets that will make some investors a boatload of cash, generating real wealth and yields of 5%, 7%, even 10% and higher. However, many investors are missing the real changes underway and are making a real killer mistake. Simply put, they're investing in entirely the wrong stocks. Listen, over the holidays I read an article written by a popular market pundit on a widely read financial website. This pundit was recommending a stock I had just finished doing some deep dive research work on. A popular, high-yield name that soared more than 50% since its February 2016 lows. Out of the 20 Wall Street analysts covering the stock, 14 rated a buy and 0 rated a sell. However, I believe it's actually an extremely dangerous investment that could collapse 30% or more by the middle of this year. And back in mid-December, I received an email asking me about another widely held stock that soared more than 50% from its intraday low in November of last year to its high in December, just over a month later. This stock looks like an industry leader to some. However, I dug a little deeper and found that this firm is in a niche that needs $70 a barrel oil to work as an investment and justify the current valuation. I believe this stock, currently trading over $60 a share, will ultimately trade to as low as $30, perhaps as soon as the second quarter of this year. And that's even if oil continues to trade around $50 a barrel. Look, I believe far, far too many investors will get trapped in these expensive and dangerous stocks and will see some painful declines in their portfolios over the next few months. Even worse, some energy stocks could lose you serious cash even without a major decline in oil prices from current levels. That's not what I desire for you. Before I go any further with this presentation, I must warn you. The views in this presentation are controversial, and some may find my financial predictions scary. Believe me, I don't want to frighten you. However, I can't be silent about my latest research. The fallout and trends covered in this presentation are among the most important and powerful I've uncovered in my entire career. You see, over the past 3 years, I've made some bold and controversial calls on some of the most popular financial websites, on television, and at financial conferences around the US. No one believed me in 2014 when I called for crude oil prices to fall to $30 a barrel or lower within 18 months. And few agreed with my calls to sell some of the most popular and widely held energy stocks, including deepwater driller Seadrill, producers like Linn Energy and Brightburn Energy Partners, even energy bellwethers like Halliburton and National Oil Varco. The conventional wisdom at the time was simply that oil prices under $60 a barrel were unsustainable, and it was a great buying opportunity. However, oil prices did break to around $26 a barrel in early 2016. Linn and Brightburn are now bankrupt, and Seadrill has eliminated its dividend and trades more than 90% off its 2014 highs. Even the stocks the experts called bellwethers, names like Halliburton and National Oil Varco, saw declines of 50% to 70% in the 2014 to 16 energy bear market. And here's what's even worse. When I recommended buying high-quality energy stocks like Anadarko Petroleum, Concho Resources, and EOG Resources at fire sale prices early last year, I caught even more criticism from my peers. You see, by early 2016, many were convinced oil was headed to under $20 a barrel and that there would be widespread bankruptcies of shale producers. Yet Anadarko, Concho, and EOG are up 80.7%, 42.6%, and 47.1% since the end of January 2016. Listen, the critics haven't been able to refute my research. However, they've been unwilling to accept the enormity of the changes underway. Many of my peers in the financial newsletter world would rather you not see the content and research in this video. Listen, I understand their reluctance to accept my conclusions. These so-called experts stand to lose their shirts as my predictions continue to prove correct. Most are advising readers, listeners, and viewers to do the exact opposite of what I'm about to tell you. However, their conventional wisdom and groupthink is already costing investors just like you some serious cash. Before you dismiss me as some sort of crank, I urge you to keep an open mind and review the detailed information and research I'm about to present. In just a moment, I'm going to show you exactly what I'm talking about and some of the once-in-a-generation changes underway in global energy markets. And perhaps most important, why I'm so worried about the conventional groupthink concerning oil and energy stocks that's so prevalent on Wall Street and in the financial media these days. I urge you to challenge every single one of my facts, and you'll find that I'm right about each allegation I make. And then you can decide for yourself. As I said, my name is Elliot Gu. I'm the co-founder and chief analyst for Energy and Income Advisor, a comprehensive financial research service dedicated to uncovering the best income and growth investment opportunities in the energy industry. Co-founder Roger Conrad and I are not new to the financial advisory and research business. In fact, we have close to 50 years of combined experience as analysts and editors of some of the largest circulation financial publications in the United States. You may or may not recognize us from our frequent appearances on CNBC, Bloomberg TV, and Canada's Business News Network. We've been quoted in a number of major publications, including Barron's, Forbes, the New York Times, and the Washington Post, and we currently serve tens of thousands of investors worldwide through our financial research firm, Capitalist Times. I've dedicated my career to analyzing and identifying profitable investment opportunities in the energy sector. The official program of the 2008 G8 Summit held in Hokkaido, Japan, even called me the world's leading energy strategist. I'm not looking to boast or brag. I reference our success and experience analyzing the energy markets because we believe there's a powerful change of trend underway right now. And I want to make sure you're on the right side of the changes underway in these markets. Simply put, the so-called experts and pundits in the financial media have been making a lot of bad calls since the energy bear market began nearly 3 years ago, because they do not understand the fundamental shift in power underway in energy markets. Geopolitics, economic realities, and fateful decisions taken by the world's largest energy firms and governments are changing world markets forever, with devastating consequences for some investors in the very near future. Meanwhile, other investors stand to see a life-changing financial windfall that will make the energy riches generated in oil booms of the past pale in comparison. And that's why we spent several months and hundreds of thousands of dollars digging into the numbers and performing the detailed research necessary to profit from emerging trends. You have a very short window to prepare for the next chapter of this historic shift. We're looking for a short period of calm. It's not too late to protect yourself. However, you must act now, because by February and early March, we believe the trends I'll reveal in this presentation will already be underway and known to everyone. This information is so important that in just a moment, I'm going to do something I rarely do. You see, in just a few days, on January 10th, I'll be giving a presentation to a small number of energy investors and VIPs. Normally only a handful, maybe a dozen investors, would ever see a presentation like this one. In normal market environments, it just wouldn't be fair to my paying subscribers for me to release this valuable and hard-to-find information absolutely free of charge. In fact, I suspect I'll get some complaints and will be forced to take down this presentation in a matter of days, maybe even just hours. However, this time, I just can't keep this crucial information under wraps. So I've decided to record a short executive summary of some of the points I'll be making in my presentation next week. I'm not exaggerating. This presentation could save you from some devastating mistakes over the next 12 months and set you up for some life-changing income and profit opportunities. It may be the most important presentation of my career covering energy markets. I've got to warn you, this video is raw and only lightly edited. It's an unscripted executive summary of some of the key points I'll be making in this presentation. However, I just couldn't delay giving you this crucial information any longer, not to clean up the audio or make a few charts look prettier. I guarantee I won't waste your time. Listen to this presentation through to the end. I'll explain exactly why the pundits have been so wrong about oil prices and why some of the most popular energy stocks today are dangerous investments. Don't delay, there's only a short window of time, a brief calm before the storm. Watch my short video presentation and decide for yourself if I'm for real or just full of hot air. Hello, my name is Elliot Gu. I'm editor and publisher of Energy and Income Advisor. And over the past couple of days, and really towards the end of the holiday season, I've been spending a lot of time putting together slides for this special strategy session webinar that Roger Conrad and I are doing, entitled Strategy Session Outlook 2017 Crude Oil and Energy Stocks. And I was just looking at some of these slides that I'm putting together, and it struck me that some of the basic trends that I'm seeing and that we're seeing are so important that I wanted to just record this brief video, this brief presentation, to just explain to everyone some of the key trends we see and how you can go about trading this and investing with these in mind. In particular, we really see an environment of some real haves and have-nots in energy in 2017. Some energy stocks, unfortunately, including some energy stocks that are very widely held, that I get questions about every single week, very widely recommended on Wall Street and among some of my peers in the financial newsletter industry, are stocks that I don't think are going to really benefit from the trends that we're going to see in 2017. There are some companies that I think are going to do very, very well, and I also want to point out today in this short video some of the areas that I think are most interesting from an investment perspective. So with that little background, let's get started. This is a very simple diagram that many of you may have seen before, and it's just a supply curve. It's maybe one of the most basic foundational ideas in economics. And the way it reads is something like this. On the vertical axis is the price of oil. And on the horizontal axis is the amount of oil supplied, the quantity of oil supplied. Now, as the price goes up, now you look at that black line there, which is sort of upward sloping from the lower left to the upper right of this chart, of this graph, and you'll see that as the price of oil goes up, obviously the quantity supplied also goes up, for the basic reason that companies want to produce more oil at $60 a barrel or $100 a barrel than they do at $30 or $35 a barrel. So when the price goes up, the quantity supplied by global producers also goes up. It's one of the most basic ideas in economics. The other way of looking at that, of course, is that if the amount of oil demanded goes up, if the amount of oil that global consumers want to use goes up, global oil consumption goes up, then the price will have to go up in order to incentivize all these producers around the world to produce more oil to meet that demand. So let's look at how this supply curve has worked over the last few years. And starting up, let's look at oil prices. I took this chart all the way back to 2010, and this is a chart of front month West Texas Intermediate crude oil futures. And as you can see, between 2010 and 2014, oil prices really didn't go anywhere. They were very stable around $100 a barrel, lows around 80, highs around 115 to 120, but basically the average price of this period was somewhere around $100 a barrel. And many people thought this was because OPEC, and partly it was because OPEC was targeting a price of around $100 a barrel. If oil prices got to the lower end of that range, sort of in the low 80s or even upper 70s, you started to hear about OPEC cutting production to push up the price of oil a little bit. And when it got to the upper end of that range, on several occasions, such as during the Libyan civil war, you heard Saudi Arabia in particular come out and say they were going to produce a little bit more oil to make up for lost supply from a country like Libya. But oil price is pretty stable around $100 a barrel. Now, $100 a barrel is a level where many producers around the world can make a lot of money producing oil. So it was a level high enough that it was encouraging a lot of production growth. In particular, and you look at this chart, this is U.S. oil production growth. And over that time period with oil around $100 a barrel, you saw a rapid development of all these shale fields around the U.S. The Bakken Shale of North Dakota, the Permian Basin of West Texas and New Mexico, the Eagle Ford Shale of Southern Texas. You saw a lot of U.S. oil production growth. So at the end of 2011, U.S. oil production around just under 6 million barrels of oil a day. By the middle of 2015, it was all the way up in the 9.5 to 9.8 million barrel a day range. So about a 50% growth in U.S. oil production between 2010, 2011, and 2014, 2015. One of the biggest growths in U.S. oil production we've seen, the quickest growth we've seen in U.S. oil production since the 60s and very early in the 1970s. So U.S. producers, like many producers around the world, responded to those high and stable oil prices around 100 by producing more and more and more oil. However, this also put pressure on prices. All this new production coming from the United States in particular, but also other countries around the world, because of these high prices, caused a supply excess. And in order to offset that supply excess, OPEC had to pretty much maintain production pretty flat around that 30 to 31 million barrel a day range. But what they found was that they were losing market share because with oil prices around 100, a lot of producers outside OPEC were producing more and more and more and more crude. And in order to offset that, OPEC producers had to produce less crude to prevent the market from getting really oversupplied. And by doing that, by taking oil off the market, they maintained prices around $100 a barrel, but they incentivized even more production from non-OPEC, which of course required them to restrain their OPEC production even more. And when I say OPEC, you can pretty much read Saudi Arabia because they're the leading country within OPEC, Saudi Arabia, and some of their more reliable partners in OPEC like Kuwait and the United Arab Emirates. These were the countries that were really restraining their own production to try to prevent growth in particular, U.S. shale production from overwhelming the market and causing a glut. At the end of 2014, and we actually began to hear about this in late 2013 and early 2014, a lot of talk about OPEC becoming, in particular Saudi Arabia, becoming concerned about this rising U.S. shale production oversupplying the global market. By the end of 2014, they were completely fed up. And so what they did was they said, you know what, we're not going to control production anymore. We're going to allow OPEC production to rise, and we're going to allow the price of oil to fall, and we're going to try to squeeze out some of these higher cost producers around the world like U.S. shale. So that's exactly what happened. Between the end of 2014, by the end of November 2014, when they announced this change in strategy, through early 2016, oil prices fell from over $100 a barrel all the way down to $26.05, which was the low in February of 2016. So big sell-off in oil prices as a result of OPEC, as you can see on this prior slide, pushing up their production, allowing production to rise well beyond that 30 to 31 million barrel a day range, which pretty much confined OPEC oil production in much of 2012, 2013, and 2014. So if you look at this next slide, in a sense, this worked. The drop in global oil prices and West Texas Intermediate crude oil prices caused global energy producers, particularly outside OPEC, to cut spending on exploration and development. So capital spending, the amount of money being spent on drilling and exploration and development of oil fields around the world, was nearly $500 billion, $500 billion in the 2013-2014 range. Some of that was large integrated oil producers like ExxonMobil or Total of France or Royal Dutch Shell or BP. And a lot of those companies, which are highlighted in blue on this chart, were spending on things like deep water developments in places like Brazil or off the coast of Africa. But an awful lot of that was also independent producers, which tend to be your big U.S. shale players like that are producing at a lot of these fields like the Permian Basin and like the Bakken Shale. And I've highlighted those in orange. And you can see that in between 2014 and 2015, there was a big drop off in global capital spending from nearly $500 billion to $350 billion. That shrank still further in 2016 to around $270 billion. And this year, it's expected to be kind of flat to slightly down. Most of those cuts came from both independent and integrated oil producers. In dollar terms, the integrated producers cut a lot between 2013 and 2016. But of course, in percentage terms, the cutback in independent oil producers, particularly those in U.S. shale, was even more dramatic than for the big integrated producers. These companies cut their drilling activity to the bone. This is the important thing to know is that this is just the supply curve in action. With the price of oil around $100 a barrel, companies were willing to supply a lot more oil. In other words, we were sort of towards the upper right-hand side of this curve on this chart. At $30 a barrel or under, they were willing to supply a lot less oil. It's just a simple supply curve in action. The price of oil fell between late 2014 and early 2016. The amount of oil supplied also fell. began to bring supply under control, which is what the Saudis wanted when they initiated this strategy back in 2014. However, there's one major problem with all this, and that's really fundamentally a miscalculation on the part of OPEC, certainly, on the part of Saudi Arabia, certainly, but also I think on the part of a lot of the US producers. They didn't realize how quickly things were changing. And what that is that because of advancements in technology, because of greater experience producing in these shale fields around the US over the last 5 years or so, technology and experience have driven down the cost of producing a barrel of oil from shale. So whereas if you can see on this chart, I've drawn this little circle up here saying average cost of producing shale in 2012. Shale production needed $70, $80 a barrel to make sense in 2012. In a lot of cases, on average, obviously different plays have different average prices, but I'm doing this for illustrative purposes. It was $70, $80 a barrel to produce your average barrel of shale oil back in 2012. Because of these technological and experimental improvements, in other words, more experience in these shale fields, they've driven down the cost of producing shale to the point that many shale fields in the US now make sense at $45 a barrel. In some cases, even $35 a barrel. So you can see that the cost of shale has fallen. Technology has driven down the cost of shale production. The cost curve has changed. Therefore, shale is no longer in that uneconomic level that it was at back in 2012, where it was unless oil prices are up around $70 or $80, you wouldn't see shale production. Now it's really in the sweet spot, even at current oil prices. How do we know that this is the case? It's really pretty simple. You'll see plenty of calculations from major banks, from the International Energy Agency, the Energy Information Administration here in the US. I look at it even more simply. The price of oil is about half of what it was in the middle of 2014 today. It's in the 50s compared to over $100 a barrel back at one point in the middle of 2014. Yet, the U.S. rig count is rising. The number of rigs actively drilling for oil in the U.S. has risen from a low of about 316 rigs at the end of May to about 530 rigs today. So the oil-directed rig count, the number of rigs actively drilling for oil, has been rising since May, even though, as you can see on this chart, the price of oil has been kind of stuck in that low to mid 40s up to low to mid 50s range ever since the middle of this year. So even with oil at about half of where it was back in 2014, the number of rigs in the US actively drilling for oil, particularly in shale, has been on the rise. Companies obviously wouldn't put rigs back to work if they couldn't make money at oil prices around current levels. And so that's exactly what's happening. Just look at this rapid growth in the rig count just since the middle of 2016. As rig count has risen in the US, and as I showed you on that last slide, it hit a low of 316 rigs at the end of May, so has US oil production. There's about a 3 to 6 month lag between an increase in the US rig count and that showing up in terms of US oil production, but you can already see that growth already well underway. In the beginning of July of last year, of 2016, US oil production around 8.4 million barrels a day. Today, it's up around 8.8 million barrels of oil a day. So nearly sort of a 350,000 to 400,000 barrel a day increase in US oil production just since last July to the present time. And with the rig count continuing to rise, as you can see on this chart, I think it's only a matter of time before you get even more growth in US oil production. So what are the key implications of all of this? First, OPEC can't push oil prices much above $55 per barrel for any length of time without prompting a major surge in US shale oil output. As I showed you, that cost curve is shifted. The technology's improved. What do I mean by technological improvements? Well, one of them is that producers have found there really are two key technologies for producing from shale. The first is horizontal drilling. In other words, instead of drilling straight down or vertically into an oil field, they drill down and sideways. And the second technology is fracturing, basically pumping a liquid into an oil reservoir under high pressure to break up the rock, break up the reservoir rock, and aid the flow of oil into a well. So those are the two key technologies. but producers have been experimenting with those and improving those technologies. So, for example, they found that by drilling longer lateral segments, in other words, instead of drilling a well that goes down 5,000 feet and sideways 5,000 feet, they found that by drilling down 5,000 feet and sideways 10,000 feet, they can see a quantum leap in productivity of that well, the amount of oil reserves that they can book out of that well. Another example is what a lot of companies are calling enhanced completions. And you may hear about this if you listen on a lot of shale producer conference calls. A lot of times that means putting more proppant into the fracturing fluid, and all proppant is sand. And little grains of sand go into the fracturing fluid so that when the fracturing fluid's pumped into the reservoir and breaks up that reservoir rock, these little kernels of sand, these little grains of sand get stuck in the cracks and crevices created by fracturing and sort of prop open those cracks so that when the pressure is reduced and the well starts flowing oil, it keeps those fissures open and keeps the flow of oil high. And so what a lot of companies have found is that by putting more sand in the fluid during the fracturing process, they get a lot more productive wells. So we call that enhanced completions. Other technologies for more carefully placing wells within a reservoir, for more carefully controlling the fracturing process to make sure that each little segment of the well is properly fractured so it's flowing at an optimum level. All these technologies, which have been developed and perfected over the last few years, have dramatically increased the productivity of shale wells in the United States and lowered the break-even costs. So what OPEC didn't count on was the speed at which this could happen. The technological development in the United States over the last 2 or 3 years has just been a lot faster than anyone had expected. Even the shale producers say back in 2013, 2014. Now OPEC is beginning to realize that they can't really push oil prices to 55 or higher because they're just at that level, almost all the shale producers can make money, and therefore you're going to see this surge in US shale production. Even with prices well under that, sort of $7, $8 less than that on average over the last 6 months, you're already seeing 350 to 400,000 barrels a day in US oil production growth, even with prices a lot lower than that. So they can't push prices above 55. At the same time, they can't really, if oil prices fall under $40 to $45 a barrel, you also have a problem because most US shale producers, or a lot of US shale producers outside a couple of plays, one of which I'm going to tell you about here in just a second, just can't make money at $35 or $40 a barrel. And so you're going to tend to see it, if prices fell to that level, you're going to tend to see the US oil-directed rig count fall. You're going to tend to see a decline in US oil production. And you're probably going to hear OPEC start to talk about cutting production to push up the price of oil because most of those countries have sort of a disastrous fiscal position at under $40 a barrel. Even your more fiscally sound countries like Saudi Arabia have trouble meeting their budgetary needs at $35 or $40 a barrel. So OPEC is really, unlike the way it's been for most of the last 56 years since it was founded, they can influence prices still, but only within that narrow range of about 45 to 55. Under that range, you're going to see supply decline, upward pressure on oil prices. If prices go above 55, you're going to see a surge in US shale supply that will make that rise in prices unsustainable over the long term. Not to tell you that there won't be spikes on both sides of this range. You might see moves into the 30s, you might see moves into the 60s, but we don't buy the view that oil prices are going to $70 by the end of next year, which some on Wall Street are saying, and we're not of that bear camp that says oil prices are going back sustainably to the low to mid 30s. We think oil prices are kind of stuck in this $45 to $55 a barrel range. Now here's the important point. Companies with exposure to fields that can make money at $50 a barrel will grow and perform very, very well this year. Just as that period from 2010 to 2014, energy stocks generally did well with oil prices around $100 a barrel because most companies that did well could make money at $100 a barrel. This time around, companies that can make money at $50 a barrel with prices averaging around $50 a barrel will do very well. We don't need a rise in oil prices to 70 for energy stocks to do well. We just need oil prices kind of stable around that $50 a barrel range which I think is exactly what's going to happen. And in just a minute, I'm going to tell you a couple areas that we're looking at of interest that fit this bill in terms of companies that we want to buy in this environment. Energy stocks, however, that need $60, $70, $80 a barrel sustainable oil, or in some cases even higher than that, they're still vulnerable. They're just too high up that cost curve. The only things that are going to make money are companies that are low enough, down and to the left enough on that supply curve I showed you, that they can make money with oil prices around 50. Those quantities that need above $50 a barrel oil, they don't make any sense in the current environment. One example of a high cost play that I think you should avoid is anything exposed to deep water oil and gas production. Now, there are some areas, there's some companies that have exposure to deep water that we think are okay, but we think a lot of them are going to do fairly poorly over the next couple of years, even though they're being widely recommended on Wall Street and among many of our peers in the financial newsletter business, because the idea is simply that if oil prices go up, it's good for these companies. That's not exactly true. A lot of deep water developments, new deep water developments in particular, in other words, going out and drilling new wells in a deep water oil environment, whether that be off the coast of Brazil, off the coast of Gulf of Mexico areas, or off the coast of West Africa, you need $60, $70, $80 a barrel oil sustained for this to make sense. So companies that rely on an acceleration of deep water drilling activity, they're not going to do well because companies are going to shun that area and focus on shale production, which is lower cost. So deep water just doesn't make a whole lot of sense. One example of a company that we think you should avoid and sell if you own is Dril-Quip. The symbol there is DRQ. This is a chart of the stock. You can see that from early November up until mid-December, it spiked from $47 a share all the way up to almost $70 a share, $69.40 a share in mid-December, simply off the rally in oil prices. But the reality is that this company makes subsea trees. That's one of their major businesses. What's this subsea tree? Well, the word tree is short for Christmas tree, which is basically the word in the industry that's used for the network of pipes and valves and other equipment that's installed on top of a producing oil or gas well. So in other words, when you drill a well and before it starts flowing oil or natural gas, you install this Christmas tree on top, which is just a network of pipes and other equipment and pressure gauges, etc., that's installed on top of the well to control the production out of that well so that the oil or gas can flow into a pipeline and ultimately to the consumer. So this Christmas tree, the reason it's called a Christmas tree is if you look at it from afar, it kind of looks like a Christmas tree. It's got that sort of shape. Land Christmas trees for land-based rigs or wells are pretty low tech, relatively low tech, not that complex. It just looks like a group of valves and basic of gauges, etc. But subsea, when you're drilling a deep water field and say that field is 7 or 8 or 9 or 10,000 feet underwater, that tree is installed directly on the seafloor. And therefore, it needs a lot of additional equipment. It needs a lot of additional equipment to handle the higher pressures that are inherent in deep water oil production. That oil is under a tremendous amount of pressure, geologic pressure. Therefore, it requires more equipment to control that. And also, obviously, you need to be able to remotely control the flow of oil or gas out of that subsea well. And so that requires more equipment for controlling that tree remotely rather than just a tree that's on the surface that you can control directly. So Dril-Quip makes these subsea trees, and the subsea tree market does really, really well when when drilling activity in deep water is very strong. But over the last couple of years, and we think over the next couple of years with oil around 50, you're going to see pretty weak growth in spending on deep water oil and gas production because the costs are too high. Therefore, you're seeing weak demand for subsea trees. And as Dril-Quip works through its backlog of orders to supply these subsea trees, many of these orders were booked in 2014 and 2013 before the price of oil collapsed. They're just not going to have a lot of revenue growth. They're going to have to cut prices to try to encourage demand. They're going to see a big deterioration in margins. So why was the price of this stock up so much between early November and mid-December? Well, as I said, one reason was just that when the price of oil goes up, there's a knee-jerk reaction to buy all energy companies. But we think as it becomes clear that the price of oil is going to sort of average around $50 a barrel, not go to $70 or $80 a barrel, you're going to see people begin to realize that this deepwater market still has trouble at that price of oil. The other thing about Dril-Quip is that a lot of people, investors, traders were short the stock, betting on a decline in the stock back in late October, early November. And when the price started to move the other way, these traders who were betting on a decline in the stock were forced to go out and cover the stock, which pushes the price of the stock higher. It's what we call a short squeeze. We think that was behind the big spike in the stock between early November and mid-December. What really worries me is that I've been getting a lot of questions from investors asking if it's time to start buying stocks like Dril-Quip because they see this big spike in the stock and they think that that's an all clear sign. We think no. We think this stock could see a lot of additional downside. I wouldn't be surprised to see Dril-Quip trade into the 30s at some point this year in 2017. So Dril-Quip, deepwater levered companies are one area of several major areas that we think you should avoid in the current oil and natural gas price environment. What are some examples of areas we want to focus on? Well, and I'm going to talk a little bit more about this in the strategy session that Roger Conrad and I are hosting for subscribers shortly, but I wanted to just in this video, in this short video, I wanted to give you a flavor of some of the areas, some of the many areas we're looking at as being good investment opportunities. And one of them is the Delaware Basin. Now, the Delaware Basin is part of the Permian Basin of West Texas and New Mexico. And you can see this map I have here shows basically West Texas and New Mexico. And you can see the Permian Basin is this whole area in the darker green color. And there are two main parts of the Permian Basin. There's the Midland Basin, which is located further to the east, and the Delaware Basin located further to the west that extends in part, it's partly in Texas and partly in New Mexico. So the Midland Basin is an area that's been under production for a long time, many decades in fact, but it's been under production using horizontal drilling, targeting these shale formations really for many years, for about a decade now. So companies have a lot of expertise drilling in this part of the Permian Basin. Wells are extremely low cost. Some wells in the Midland Basin, shale wells now, can make money at $25 or $30 a barrel even, can break even at $25 or $30 a barrel even. So the Midland Basin is an excellent area to produce oil. However, we think that the bigger opportunity is actually in the Delaware Basin. Delaware Basin has similar economics to the Midland Basin. However, it's in an earlier stage in development, which means that there's more upside. There's more potential for wells to exceed expectations. And there's probably more growth in production in the Delaware Basin because it's, let's say, 2 to 3 years behind the Midland Basin in terms of development. So we want to buy companies with acreage in the core of this Delaware Basin, part of the Permian Basin, again, which is located in West Texas and New Mexico. These producers, in some cases, have thousands of potential drilling locations they can exploit over the next few years. They're going to see a lot of production growth at a low cost, and they can do phenomenally well in that $50 a barrel average oil price environment. So we want to be in the Delaware Basin of West Texas and New Mexico. We also are starting to get additional interest in what we like to call second-tier plays. So these are not the lowest cost oil fields in the United States. These aren't the Delaware basins of the world. And I will tell you, in our main strategy session that I'm hosting with Roger Conrad, which all of you listening to this video can actually get risk-free access to, I'm going to be talking about a couple of other major shale fields in the U.S., including one that we think may be the most exciting of all, that are like the Delaware Basin, early in the production process, early in their life cycle, have a lot of upside potential and have excellent economics. But we're also starting, and this is a relatively new development for us to be recommending these stocks, we're also starting to get interested in what we like to call second-tier shale fields. Now, it's not that these shale fields are bad, they just don't have quite the great economics of a play like the Delaware Basin. So they're a little higher cost of production, but we're beginning to see some rapid development in that. As new technologies are rolled out in some of these second-tier plays, their economics are improving very rapidly to the point that they're getting to the point where they're becoming almost competitive with the Delaware basins of the world. So one example of that would be the Bakken Shale, sometimes called the Williston Basin, which is located in North Dakota. Historically considered a play that needs $60 a barrel oil to make money. We're increasingly seeing producers, though, drilling wells there using new technologies, enhanced completions, fracturing designs, better well completions. They're making money, lots of money, even with oil around $50 a barrel, a little under $50 a barrel. Some cases are earning 40, 50, 60% returns at $50 oil. They're, we think, going to do very well in the coming few years with oil hovering around $50 a barrel. Look, I know many of my peers are in serious denial about the real trends underway in global energy markets. Far too many are sounding the all clear to buy energy stocks in the wake of OPEC's agreement to cut oil production for the first time in 8 long years. However, these so-called experts are ignoring the big shifts in the cost curve over the past 2 to 3 years. And one absolutely crucial fact. Today, U.S. shale producers, not countries in OPEC like Saudi Arabia and Kuwait, are the real power in global energy markets. These changes mean that energy stocks can be divided into very profitable haves and some dangerous have-nots. We're seeing plenty of firms that can produce oil profitably at prices of $50 a barrel or less, and companies that own pipelines serving the most economic of those U.S. shale fields. Some of these stocks offer upside of 50% to 90%, while others are income plays with yields of 9% or higher, and the potential to grow their payouts by 10% or even 20% and higher every year over the next few years. However, some of the most widely recommended stocks today can't make money until oil tops $70 or even $80 a barrel, and that's not going to happen, not anytime soon. Some MLPs and income-oriented energy stocks are suffering because they're quite simply positioned in the wrong markets. Will you act now to protect your portfolio and position yourself to profit from the shale revolution? A once-in-a-generation shift in global energy markets? I hope so, and that's why I created this presentation. So what can you do? Well, I've done a lot of research on this, and I've found that there are a surprising number of simple things you can do to not only protect what you've currently got, but also to potentially make quite a bit in energy markets over the next few years. And just for watching this presentation today, I want to issue you a very special, risk-free invitation that's open to just a handful of our current subscriber base. Less than 1% of our database. My colleague Roger Conrad and I want to give you our quick start guide to the key profit steps you must take to profit from OPEC's recent production deal, the policies of President Donald Trump, and the generational changes underway in global energy markets. Simply put, I want you to attend our detailed energy investing strategy session and presentation scheduled for January 10th at 2 p.m. Eastern Time. Don't worry if you can't attend the event live. Your risk-free registration entitles you to receive a recording of the entire event and a copy of our presentation slides for review at your leisure. Attend this event and we'll explain the U.S. shale oil field that's been a hot topic at just about every energy industry event, conference, and cocktail party Roger and I have attended over the past year. While this field has the energy industry buzzing, it's still largely a secret to most individual investors. We'll cover the 2 best-positioned producers in this under-the-radar shale field, including our exact recommendations for when and at what price to buy the stocks. Plus, we'll tell you the names of 2 master limited partnerships, MLPs, with yields of 7.9% and 8.4% that own crucial infrastructure right in the heart of this highly economic field. And don't forget, it's just as important to know which wealth-sapping stocks to avoid as to understand the best names to buy right now. We'll also uncover a large oil producer with a $15 billion market cap with acreage in this secret shale field that's widely recommended to investors. Yet, this popular stop's acreage is not in the most profitable core of the field, and its exposure in other regions has us very, very worried. Trust me, you'll want to sell this widely held name right away, as we believe it could collapse as much as 40 to 60% in 2017. And we'll also cover the 3 absolutely crucial energy infrastructure projects we're monitoring that are now on the fast track for completion thanks to the incoming Trump administration. These projects are reopening what some believe to be the largest single accumulation of oil in the world. Our top pick is a high-yield name that we've been covering since 2005. Since then, the stock has consistently raised its dividend, even through some of the most extreme bull and bear markets in stocks and oil in history. However, what makes this company so attractive is that it has the pole position in a critical resource that's going to be in very high demand as the three projects we're tracking are completed. Plus, over the past 3 years, U.S. natural gas exports to Mexico have jumped an incredible 194.07%. And demand is only going to grow as Mexican gas production just can't keep pace with demand. You may never have heard of our top recommendation on this booming growth market, as this company is not a household name. However, our under-the-radar pick has a 3.9% yield and the potential to triple in size over the next few years. And we also want to tell you exactly what the smart money is doing in energy markets. I'm talking about the private equity firms that are quietly buying up North American energy assets on the cheap right now. Our research confirms that one small firm in the US with an 8.4% yield that's growing its payout at 10% plus per year is an extremely likely takeover target for these smart money investors this year. Trust me, you want to buy this stock, currently trading at around $20 a share, right away, as we believe a takeover offer at a fat premium could be imminent. Look, I don't have time in this short video to tell you about all the trends, recommendations, and warnings we're planning to cover in our Energy Outlook Strategy session this month. And quite frankly, this event would normally be open only to long-time paid in full VIP members to our service. Yet, as I said earlier in this presentation, I believe the information we're covering is so crucial to your wealth and investing success this year. I've decided to offer invitations to attend this VIP event with absolutely no risk or obligation. However, I must warn you, I can only open this offer to 15 readers who have viewed this presentation. And if I receive any complaints from our VIP readers, I'm going to have to take this presentation down and close the offer immediately. Simply put, I want to make sure you guarantee your risk-free place at the virtual table before it's too late. Here's how it works. Simply click the button labeled Start Your Risk-Free Trial, located below this presentation, and take a trial subscription to Energy and Income Advisor. Read 2 detailed monthly issues of Energy and Income Advisor. We'll also tell you exactly how to log on to our exclusive members-only website and access our model portfolios offering suggested allocations for growth, income, aggressive, and conservative investors. And I want to make sure you're on the right track with your energy investments starting immediately, even before you've had time to attend our special VIP online strategy session. The first step is to sell the most dangerous energy stocks in your portfolio right away before the next wave of the energy cycle unfolds. Once you've logged on to our website, I want you to read our latest hot-off-the-press research report titled Risk Avoidance. In this report, we've identified 8 widely held energy stocks and MLPs that we consider particularly dangerous investments this year. The list includes some income stocks we believe could have to dramatically reduce their dividends this year with devastating consequences, as well as some growth names that are set to disappoint investors even if oil prices hover in the $50 to $60 a barrel range this year. The next step is to have a look at our short list of 10 energy stocks and MLPs with the most upside potential in 2017. Roger and I spent weeks debating our 10 highest conviction recommendations for this year, and we've summarized all you need to know in this brand new report titled Top Energy Stocks for 2017. Now let me ask you a simple question. Wouldn't it be great to be able to pose any question you like about the stock market, economy, or individual stocks and bonds and have your questions answered? Let me tell you about our monthly web chats, a feature of our service Roger and I pioneered a decade ago. It is still the most popular feature, bar none, of the Energy and Income Advisor service. These chats are an opportunity for you to ask us any question you like about stocks, our recommendations, the economy, or the broader market. Ask any question you like, and we'll answer every question we're asked on the chat. Our next scheduled online chat is coming up in just a few weeks. Just enough time for you to read our research, attend our VIP Energy Strategy session this month, and prepare any questions you have. Click the button below this video, sign up for a risk-free trial subscription to Energy and Income Advisor, and we'll rush you the details of how to log on to our exclusive subscriber-only online chat. We believe there's no better service on the market today, and all we're asking is that you give us a fair try and see for yourself. If you don't believe it's worth every dime of the subscription price, cancel in the first 30 days to receive a full refund, no questions asked. We guarantee it. And for viewers today, we're offering Energy and Income Advisor at our special introductory price. Test our service for 30 days, read our research, and join our monthly web chat. Then decide. If Energy and Income Advisor isn't for you, cancel in the first 30 days, keep your reports and your recording of the VIP Energy Strategy session, and I'll refund your full subscription price, no questions asked. Here's to your wealth. To start your risk-free trial, please click the Start Your Risk-Free Trial button below this presentation and join us today.